Hi, Ellie. Great to have you back on the show.
And you, Andy, thanks for having me back.
Not a whole lot seems to have changed in the world of interest rates and mortgages, does it? In fact, I feel like we're further away from a potential date where they might start bringing rates down than we were last time we caught up at the end of 2023.
I think so. They were talking about mid-2024, weren't they? But inflation's not moved, so...
It hasn't budged, no.
No, and no election date, so no.
Yeah, so, well, it's probably not worth us spending too much time on that. But what I was hoping we could do today was talk about a topic that comes up regularly in our community around funding conversions of residential houses to HMOs, and quite specifically, the best way to do it. Should we be using cash? Should we be using bridge finance? Should it be a combination of both? What's available out there? And I think the truth is there are a number of different options, aren't there? And it's, the best scenario might be a little bit different for everybody. But I was hoping that today you could help our listeners understand a little bit more about those options that are there to help them buy and convert a residential property into a HMO. How does that sound?
Absolutely. Yeah, it's a question that I get asked often as well. So, yeah, I think it's a good one to have on the podcast and there for everyone to have a listen. So, yeah, I think that's useful.
Well, I guess the first big question that I want to ask, and I think on behalf of everybody, is why would we use a bridge, Ellie? Because I think bridging, and I probably sort of include myself in this, it scares people. Often we think it's expensive. We think, it can be quite difficult to sort of meet the terms that are imposed on us on bridging, the timelines and things like that. We obviously talk about alternatives like raising private finance a lot on the show, but that isn't necessarily an option for everybody, and certainly not at the early stages of their journey. So why should we consider bridging just, at the outset, before we get into the details of what different types of products are available? Why would we consider bridging?
Okay. So I think you're right. People are scared of bridging. And I think that comes from historically, there has been less regulation around bridging lenders. You hear horror stories, don't you, about people that have been, have all these interest rate charges that they've been added on and fees and things when things don't go to plan. And we have moved on hugely from that place. But the big thing I would say is if you're using a reputable broker, and I'd include myself in that, we are so precious around our own reputation that there is absolutely no way that we're going to use a bridging company that is going to not treat our clients well, because what's the point in me doing that? I want my clients to come back to me again and again. So I am super picky about the lenders that I go to. They are regulated. A lot of them are banked. They're not going to, up your interest rate if you go over your bridge terms. They're not going to repossess your property the second that you aren't able to repay that back, on the date that you've said you are. So yeah, as long as you're working with reputable companies, it is just a mortgage. That's all it is. It's just a mortgage. But it's based on the project rather than the rental or your income or whatever. It's all around that project.
So you obviously have a network of bridge lenders that you are comfortable using because, they work well, they understand our industry. Are there still sharky lenders out there? Sharky and bridge lenders, yes?
Yeah, of course. I mean, I've had a client recently where they've gone to a one-off little bridging company and then they've come to us for the refinance, and it's taken an awful lot of negotiation from us direct with the bridging company to stop that property from being repossessed. It's been a bit of a nightmare. There is a very big lender that I'm sure everyone's heard of that pop up at a lot of auction and most trade shows, and I'd put them in that camp. If you don't pay off your bridge in the amount of time that they've given you, they up the interest rate by a huge amount of money. There's charges that are added on and all that sort of stuff, and they are quite open to repossessing property. So yeah, there are lenders out there, but I would say go to a reputable broker.
I think it's definitely worth discussing because, I guess it confirms that it's not a myth. There are some sharky bridge lenders out there. And I think, I don't know, I suppose if there's a clear understanding of what you're trying to achieve and a lender really gets it, actually they don't see as much risk. So they don't need to apply all these interest rates and penalty charges and things like that. Whereas perhaps some of these other lenders who don't understand what you're doing as much, who aren't paying as much attention, who are quite happy to take all the fees and things like that. And I suppose you have to be quite careful because I think for a lot of people, those lenders are probably quick to say yes to certain things.
Of course they are, yeah. They're quick to say yes. And there's a lot of lenders there that they won't do a valuation. They'll just work it off an automated ABM model. They will put charges on your own home or other properties. If you want to go above 70, 75%, they'll lend you 100% of the purchase price, often more than that, but they're putting charges on other properties. It's not just free money. If you're not able to pay that back, then those other properties are at risk. And if you're not having a valuation carried out at the beginning, you haven't got that GDV in your mind about where you're heading for, you don't know whether all your figures are correct. If you're borrowing 100% of what you need, like purchase price and refurb costs, that deal needs to be really profitable in order to be able to repay all of that back. So just beware, like, there's no smoke where that fire is there. You know, if you've got somebody who's willing to give you something that you think, well, that's a lot, that's quite a big risk.
Yeah.
I'm putting nothing in and you're putting in everything. Yeah, there's not going to be, without its issues.
I mean, yeah, if they're putting that much in, they're practically just buying it for you. But
Well, exactly.
at the end of the day, at the end of the day, you are on the hook, and these are all PG, your personally guaranteed loans, and I think actually, and maybe we'll come on to this, but the ability to exit these deals is absolutely critical, isn't it? There's got to be, whatever you do, enough profit or enough equity left washing around that deal for you to move on to a term product with either another lender or, you know, one of their different products or something like that.
Absolutely. And I think that is key. And that really comes, again, down to the broker. And I think there's a lot of brokers that do a small amount of bridging in the mix of other things, and they're not necessarily going to be quite as careful perhaps, or don't quite understand the process in the same way, or particularly I think HMO conversions or something that is very bespoke, isn't it? It's a very specific product that you need, and there's not many people out there that specialise in that. So you'll be talking to somebody who might do one or two every couple of months or something like that. So they don't necessarily know. They might take what, you know, they'll look at your figures, they go, okay, well, if that's what you think, then fair enough, and they'll go with that. Whereas if you've got someone who's doing it day in, day out, like I do, I will question those figures. You come to me with a GDV. If I don't think that's right, then I'll question you on that, and we'll figure that out, and we'll know where you're heading, and we'll know that we'll be able to exit that. And there's absolutely no way that I'm going to give, you know, sort of bridge up for a client that I don't genuinely think I'm going to be able to get up for them. So
I think a lot of people would think that the most critical thing is just being able to get a good bridge in the first place. And obviously that is important. But actually, the most critical thing is knowing that whatever bridge you do get, you can get off it safely to your term product at the end. Yeah,
I think that's the thing, isn't it? If you're comparing two bridging products, for example, if you're looking at them as if you're looking at two different mortgage products, you might be looking at, okay, so what's the overall cost? What's the interest rate? What are the additional fees? But you're not necessarily thinking, have I got this bridge for long enough? Because it's cheaper to get a bridge for 6 months than it is for 12. But if you need 12 months, then it's far cheaper to get a 12-month one than it is a 6-month and then have to rebridge or extend or whatever. So it's got to be the right product for you. And also lenders will give you something to start with that isn't necessarily what they're going to complete on. So often, like when a valuation comes back, they'll reassess the terms. They might drop the loan to value. They might up the interest rate. There's all sorts of things that they can do with that. So then when you complete on that bridge, that's not what they've said to start with. Whereas the lenders that we would work with, I know that they will complete on the terms that they're giving you on day one. So it's very difficult to sometimes to compare, you know, on a like-for-like basis. So like you say, the most important thing is making sure it's appropriate for you and it's something that you can exit from in the amount of time that you've been given.
Okay, so there are some shaky bridge lenders out there. There are also some great bridge lenders out there, and if you use a reputable broker, you know, it shouldn't be too difficult. Like yourself, obviously, it shouldn't be too difficult to access them. So we're talking today specifically about buying residential properties, existing residential C3, and converting it to HMO C4. So Ellie, why I'm thinking about questions that our listeners might be sat there thinking, why wouldn't I just buy this residential property then on a buy-to-let mortgage and or use some of my own cash just to do this cheaper than or easier than I could do a bridge?
Okay, so they're two completely different things. So we cover off the buy-to-let bit first. So why shouldn't you use a buy-to-let mortgage? Well, firstly, it's against the terms and conditions of your mortgage on a buy-to-let to then convert it to an HMO. When you take out a buy-to-let mortgage, you are using it immediately for a buy-to-let. That's what the lender wants. So they could ask you for ASTs. They will want you to see your buildings insurance, and your buildings insurance is going to be for a vacant property, not a buy-to-let. So that won't comply. If they know that that's what you're doing, they're not going to lend to you for that basis. So firstly, it's the wrong thing to do. From a practical point of view, and I've seen a lot of this where people have tried to do this through different brokers, that often the property you want to buy for an HMO conversion is not necessarily something that's going to be livable, you know, in good condition. So either you'll get a zero value on the valuation because the property is not mortgageable or not rentable. And the second thing is if it is location dependent, sometimes you can get away with this bit, but the rental will not be sufficient to get you to 75% with the property in its current condition, assuming that you're going to let it out on a single let basis, which is what you're telling the lender that you're going to do. So I've had a few examples, one recently where a client tried to get into it on a bridge, which is the right thing to do. He decided he didn't want to. He's gone to a different broker. He took out a standard mortgage and he only got to 50% loan to value, whereas I'd have been able to do, say, 75, because the rental is not enough with this relatively poor condition property on a single let basis. So practically it doesn't work, and you shouldn't be doing it because it's against the terms and conditions of your mortgage.
I guess also just to add to that point, a lot of people doing these sorts of projects will be looking to refinance to the term product as quickly as possible at the back end.
Yeah.
If you were to use a standard buy-to-let, breach the terms, that stuff aside, you're then likely to be into things like early redemption charges, finding it difficult to actually get off that mortgage onto a new mortgage.
Absolutely. And then by the time you've paid the early repayment charges, you might as well have paid bridging rates. If you think bridging rates are around 10% per year, I mean, a tracker mortgage, so one without early repayment charges, is probably looking at about, 7 or 8% probably. There's not that much difference from that point of view. Also, if you're then looking at early repayment charges, if you're adding 4% onto, say, a 5 or 6% fixed rate, again, you're back up to bridge rates anyway, aren't you? So
something else that I've become increasingly aware of as well, Ellie, is, let's say you've finished the project, done the refurb, you want to get some tenants in. If it's a HMO that needs licensing, you're going to have to apply for that license. And on the license, there is a requirement to notify all of the interested parties. One of those interested parties is obviously the lender. It's all very clear. And actually, by mistake, because I've done a lot of these over the years, and we used to actually do them for our landlord clients as well. Sometimes we would forget or just leave some of the information missing, but the councils go and they do the land registry checks. So they would write to us and say, we can see there's an interested party here. Can you, add this information? Can you confirm that you've got their permission? So actually, if you came to the end of this project, you wanted to get onto a term loan, if you want to maximize the value, or you're going to want to get your tenants in first, if you want to fill it with 5 or more, you're going to need a license, which means you're going to have to notify the council, who then may notify your lender as well. So
I've had a client who's told me that they've written to the lender and asked them whether they've given permission.
So the council actually wrote to the lender. Okay, so I mean, every council's different. So
if you want to go into this as a business, you wouldn't go into any other business and try and cut corners and do things the wrong way. You just wouldn't do that. And I think because it's potentially available, people think that they can or they should. If this is genuinely your business, you need to do things the right way. And I think increasingly lenders are becoming more and more that they don't want people, they don't need the business at the moment. Lenders do not need the business. They've got enough decent business coming through the door. They don't need to do things the wrong way, just like none of us do. So I've had a client recently who converted a garage in the garden to a 6th room, and there's HMOs, there's 5 bedrooms in the house, converted the garage to a self-contained unit in the garden whilst on a term loan with a lender. We've come to refinance at the end. The best option for him was to go back the same lender. So we've had it valued. Valuation's gone back in. They've spotted that he's done this garage conversion whilst he's on a term loan with them. They won't work with him again.
Oh, wow.
They're not interested in that deal or any other deals because he's broken the terms and conditions of his mortgage. So I think if you want to do this as your business, as your full-time job, you need to do the right way round, because it will only come back to bite you on the bum at some point in the future.
There's actually a lot of reasons. I'm just thinking as well, if you were to apply for some sort of a planning permission that you might need and things like that. I mean, if you got into a bit of a sticky situation trying to apply for planning or do some work under planning with the wrong mortgage products, that could at some point backfire as well. I mean, we've talked about it for a number of years on the show and in the community now, but there's no doubt that being a landlord has become more of an actual profession rather than something you could just do on the side. And I think you're absolutely right. I think you've got to approach this like you would do anything else. You've just got to do it in the right way. Otherwise, you're likely to find that there's some sort of an issue. Something's going to bite you. It's probably going to cost you more in the long run, isn't it?
It will do. Yeah.
Which is ironic.
Yeah, okay. Exactly. So why would you use bridging over cash or investor money? So, like I said, the 2 big reasons that I would say is, firstly, by buying it on any kind of mortgage, you're going through the lender's legal system. So a lender's legal team is looking at that, and they will spot if there's anything on the title, anything to do with the property that would mean that it might not be mortgageable. If you buy it cash, your solicitor is only interested in you rather than from a lender's perspective. And something that you can buy doesn't necessarily make it mortgageable. So that's the first thing. And if you're doing it with bridging or with a mortgage, then you know all that information upfront before you buy the property. So you might want to negotiate the purchase price or not buy it. Whereas once you've already bought it, you've already got the problem. The other thing is all around the valuation. And this isn't necessarily for every bridging company. And it comes back to like the reputableness of the broker and the lender. But all bridging lenders that I work with, if you're doing works for a property, we will give them the schedule of works, costings, timescales. The valuer will check all of that out, make sure that they're comfortable with those figures and the timescales. So that's a sense check of a separate person to make sure that all that's going to work. And also, more importantly, they'll give you a price for now, how much the property's worth now, and a price once you finish those works. So you know exactly what you're going into. You know that you're paying a fair price now. And I know we can have disagreements about what valuers say property's worth, but at the end of the day, they are qualified. That is their job. If you're buying something for 200,000, the valuer says it's worth 150. That gives you the opportunity to go and sort that out now rather than overpaying by 50 grand. And then you know your GDV. And in an ideal scenario, we would use the same valuer for the bridge as we would do for the term. There's loads of ways that I can facilitate that, either with the same lender or different lenders. And then you know the figure that you're heading for. The times that I see clients that aren't making money on their end value, 9 times out of 10, they've bought it cash. So I've got no sense check around that purchase price. Because often you're making your money on your purchase price. You know, I would say probably half the profit that you make on the HMO conversion is by buying well. And if you've overpaid, that's money straight off your profit. And then the GDV, you know, every valuation that I have back is like 40 pages long. And there'll be 2 or 3 pages in there of commentary around how the value has come to the value, whether it's sold comparables, whether it's yield based, whether it's likely to get commercial valuation. All that commentary will be in there, and it will allow you to then make a decision. Is this the property for me? What lender am I going to go to on the exit? What value am I likely to get? You know all of that before you've bought the property, and you won't get that unless you're using bridging.
No, I'm not sure that many people are aware of that degree of confidence that you can get from using a bridge. And because we're talking specifically about HMOs, these are bridging products that really understand and want to lend on projects that they know you are converting to HMOs. So they really do get how to value these things at the back end. They get what you're trying to do and trying to achieve. Absolutely. And going into a deal, buying something with that degree of confidence on, I know that this is going to be the value at the end of the project. It significantly reduces the risk, doesn't it?
Absolutely. Yeah. We had one valuation back in yesterday, and the client thought he was getting a really good value, good buy on the purchase price. He isn't in reality. He's buying at a fair price. He thought the GDV was going to be, I think, 650. It's coming at 490. And he's got all the commentary around that about why that is the case. And I know that you can do your research, but naturally, I think as an investor, you will be looking at the best case scenarios of things, whereas a valuer is far more cautious, shall we say. So, but that every valuer is. So there's no point you saying as an investor, I think this is what, my GDV. Whereas if you've got a valuer that's come in and said, this is what I think it's worth, the likelihood is that's roughly where that GDV figure is going to be, isn't it?
Yeah. We've all been there and had a valuation at the end or when we've come to a refinance and it's not been quite what we've been expecting. And we know full well that it's almost always impossible to appeal it. So the reality is we can kick and scream until we're blue in the face. But at the end of the day, that valuer's opinion is ultimately what is going to determine how the deal looks and how we get out the value.
Yeah,
so
exactly.
We may as well know that at the front end, right? Rather than wait and be surprised at the back end. Because we can plan around that at the front.
You can negotiate the purchase price. You can reduce your cost of works. You could not put, if your property is not eligible for commercial valuation anyway, do you need 3 bathrooms? Could you get away with 2? All those things on there you can have a look at, and then don't you? You know that information, and you know it before you've committed and bought the property.
I've worked with a number of people, a number of my mentees, and they've been in very similar positions and scenarios, and they've been told at the front end that the value isn't going to be quite what they hoped at the back end, but because they were told up front before everything was sort of purchased, they were able to modify the schedule of work. So actually, rather than do the 6th room in the loft, let's not do that. It's not materially changing the value here. we can significantly reduce the refurbishment budget, we can reduce the timeline, and actually the economics of just modifying it and looking at the valuation based on 5 was much more favorable than it was trying to do the 6. And I think a lot of this is actually about, we talk a lot, and certainly inside the roadmap where we've got a number of lessons on stacking deals, which I'm really clear in saying that bit is the science, the numbers bit and plugging it, doing the spreadsheet, that's all the science. But actually there's a whole art to stacking deals. A big part of it is absolutely understanding what your lenders want and need, understanding how valuers actually think about things. It's understanding what you can add or take out, and sometimes how just rebalancing or changing your schedule of works can actually make a deal more profitable. And sometimes you might be quite surprised by that. Sometimes we often think the bigger the better and the more money we're going to make, and actually often that's not actually the case.
You can overspend entirely. I think there is 2 sides to that as well. Going off on a tangent slightly, you've got things that you will do to a property on a refurb that will add value, but there are also things that you will do to it to make it last longer and to make people look after it better and to lower your maintenance costs. So, you may well choose to spend on a slightly different kitchen or a better boiler system or whatever it might be, that's not necessarily adding value, but hopefully will long-term claw something back.
I'm smiling because there are also a few things that you can do that look good on Instagram, but unfortunately that's about the only value that they hold, and there is some truth in that as well. Okay, I mean, it's a really solid argument, isn't it? And, just to add to this point, I like to have some cash in the bank. I've been there where, I'm in the overdraft. I don't really do that so much these days, but when I was younger, I would really squeeze things as much as possible, but it's not a nice place to be. Right. Anything can happen, not even anything to do with the deal. You just might need a bit of cash, but actually I have found over the years that it's much more favorable just to have a bit of cash washing around in the business at the end of the deal to soak up some costs or bits and pieces that you just weren't aware of.
Of course. Yeah. Nothing goes exactly to plan, does it? Everything always takes a little bit longer. The build costs are a bit higher. It might take a little bit longer to get it finished. So then you're paying, an extra couple of months before you've got tenants moving in, whatever it might be. So yeah, you're absolutely right. Stretching yourself, spending every penny that you have on a project to avoid the cost of bridging is not necessarily wise.
Yeah. And we talk a lot about scaling up and access finance, access to deals. There are 2 key components there, the ingredients we need to actually build and scale a business. But there's a finite amount of capital that we all have. Some of us might have more than others, but at the end of the day, there is a finite amount to what we have. And the more finance of other people's money, whether it's banks, bridges, whatever, that we can get our hands on to use, the easier it's going to be to scale. And if we can build our deals and make our deals work around the numbers that we have to factor in for a bridge, if we can actually do that, make it very profitable, pretty much get out of it, create the equity that we need to leave to the residual deposit, that is actually, if we get that right, most of the time, it becomes much more scalable. As soon as we start introducing our own capital or relying on our own capital, there's a limitation because we've only got so much capital. So
absolutely. Yeah, it is. It makes perfect sense. The other thing just to mention is, if you're relying on private investor finance, it's not as reliable. It's an emotional decision, isn't it? A lot of the time.
Well, we just had an investor who has decided that actually they would like to buy a house themselves. And I've asked if we could repay their loan early. And, we'll make efforts to do that. We don't necessarily need to, but we will do. But there's definitely that emotional piece involved. You don't get that with the banks at all.
No, you don't. I mean, sometimes I suppose to start with, it's an easier discussion, isn't it? And it's like either you're going to do it or you're not going to do it, and it's not reliant on legals and valuation or the rest of it. But just as easy as somebody can say yes because they actually know. Yeah, it's a much more emotional decision. So relying on that as your sole form of finance, again, you could be spending thousands on legals, the purchase costs and everything, and then at the last moment somebody pulls out and you haven't got the cash and you're not able to do it. So a bank is going to be, as much as it's a bit more tricky to get to the yes, once you've got a yes, it's a yes, isn't it?
Yes.
It's not.
Okay, so a good solid argument then for using a bridge over cash. So we can cross out buy-to-lets, we can cross out cash. Let's talk then about the different types of bridges, because there are a couple of different types of products, aren't there, Ellie? And again, I think this, I'm such a nerd, but this for me is a lot about the kind of the art of a deal as well. We might think that there is a particular type of product or way that we should approach it, but actually it very much depends, and I think you're probably going to tell us, on your circumstances and the deal. So talk to us about the different types of products that we can access.
So there's mainly 2. So one is a straightforward bridge, as most people will know. And the advantage of this type of bridge is that we can really maximise that day one loan. So we've got a couple of lenders that will go to say 80% net, got one that will do 85 as their fee on top. There are a few bits that come off, but generally we can get to about 80%. So it gives you a much higher day one loan. That's generally for light refurbishments, although we can do some heavy. And what that allows you to do is get as much money up front, really helps with your cash flow, and then you would fund the refurbishment works. You've always got to have the money in the bank to show the lender that you've got the money for those refurbishment works. And as I mentioned before, the schedule of works will be checked by the valuer, and the valuer's got to agree with those costings. So if you say you're going to spend 30 grand on a huge refurb, the valuer's going to come out and call you out on it, and all those figures will be adjusted. So you have got to have that. That works really well for either deals that aren't particularly profitable in their own right, or deals where you haven't got a huge refurb cost. So I'd say anything up to about 50, 60,000 refurbishment cost, you're probably going to end up with more money that way than the alternative. But yeah, again, it does depend, and we can sit and figure out all the figures. The other way of doing it is what's called a refurbishment bridge. It's basically development, really. It's bridging towards the purchase and then the refurbishment costs. So different people call it various different things. I have had a bit of confusion with some potential clients around, do I get a bridge and then I get the development money separately? No, it's all one product. You only get one shot, really. So you get one charge on a property. So you need to go with what you want to do to start with. Don't try and bridge it and then borrow extra money afterwards. It's not the cost-effective way of doing things. So the way that works, slightly more complicated, it's all based on the GDV. All of it is around the GDV, and the maximum loan that the lender will go up to is 65% of the GDV. Now, I get some people trying to push back on that. Do I want, can they not lend me more? Can we not go up to 70%? Well, let's think about this. What are you going to refinance at? 75% of your GDV, right? So you are going to have costs apart from that loan that will probably need to be repaid. There may be market changes, property prices might drop. There may be some issues in the market in terms of a lender's going to cap things at 70 instead of 75 if there's a lot of uncertainty. There's a huge amount of uncertainty going on around the world, which could impact on the financial situation in the UK. Do you want to maximise that loan up to 70 or 75, knowing that you can only borrow 75 on the exit? I wouldn't. That's not something I would want to do. So logically, that 65% gives you a 10% buffer. So if anything goes wrong, digital costs, changing market situation, means that you can be comfortable to come off that bridge, which, as we've discussed, is the most important thing. So your maximum loan is 65% of your GDV. The lender will always fund all of the refurbishment works. So deduct that from that figure. And then what is left is your day one loan with some fees and interest in. So if it's really profitable, you might think, oh, I can borrow all of my purchase costs. Well, you can't. Generally, you're looking at 70% or slightly under towards your purchase. You need to put some cash in the deal. The lender wants you to put some cash in the deal.
They're not going to just buy the deal for you, are they? You've got to put something in.
They might as well do it themselves. And then they will give you the refurbishment works in arrears. So that means that you have to spend some money and then you will get it back. So the minimum you really need is about 20,000 really to start the works. And then you get that back. Be careful. The lenders that we work with, it's purely based on that GDV, and then it's based on invoices and what you've spent to get to the GDV. So it doesn't matter. But see, when you strip out a house, the value of that house is going to go down, isn't it, before it goes back up again? There are some lenders out there that will lend you, say, 70% of your purchase, and then will give you drawdowns as you add value to the house.
Not necessarily as you do the work.
No,
right.
No. And often the value will go down before it goes up. It's only really going to hit that, especially if you're relying on a commercial valuation, it's only going to hit that commercial valuation when it's finished. Yeah. So really, you can only take those drawdowns when the property's done or very much nearly done. So be careful. There are a couple of lenders out there. I don't use them. It doesn't work. But there are a few lenders out there that do it that way. But yeah, the lenders that we work with, you will have an asset manager or a monitoring surveyor that will come out, check the invoices that you've spent, and then that money will get refunded to you super quick. They will try and give you that money as quickly as possible.
So you'll have that money, what, are we talking 3 days, 2 days?
Yeah, a day or two. Yeah.
Right, okay.
They check it, they go back to the lender, and then it's refunded.
I've actually obviously experienced this a number of times myself. I'm really asking these questions just to help make sure our listeners have a really good understanding But again, every lender is different with this stuff. So what we're saying here is, Ellie, is this what I would typically think of as like a bridge to term product, or is that?
No. So the lenders that will do the bridge to term will do a standard bridge. They won't do the development money as well.
Okay.
So you can either go standard bridge, you pay for the refurbishment, and then you can use that same lender. There's only really one lender that does that.
Right.
Well, but you can use that route. They will lend you 85% of the purchase. Which the way that they've set it up is 75% towards the purchase and then an additional 10% to cover some of your refurb costs. So that's how they set it up. And then they will do the exit for you as well. So they're brilliant for commercial valuations on HMOs. The rate's not the cheapest.
No.
But there are good discounts for using them for the bridge and the term. Like you get discounts off your arrangement fee. There's less legal fees. It's a quicker process because you're staying with the same lender. So there are advantages of staying with them, which you can balance out against the rate. I did an example with a client yesterday, and actually there was nearly 1% difference in the interest.
Okay.
It worked out over, he wanted a 2-year fix, and it worked out less to stay with the same lender on the more expensive rate than it did to move somewhere else.
Just because of the fees?
You get.
Oh, for your discounts and fees. Right, okay.
Yeah, so it was a lower arrangement fee, no legals, and a quicker process. So by the time you took that difference into account, it was less. So it's worth looking at the whole, the whole scenario, obviously, and not just the rate.
So, Ellie, just back on then the refurb bridge. So if we took a broad brush to it then, as a general rule of thumb, as a percentage of, let's say, if we took the purchase price plus the refurb, roughly speaking, what sort of a deposit are we looking at having to put down against the total project's purchase and refurb costs?
Yeah, you'll need, say, 33% for the deposit, and then about 20,000 to start the works.
Okay, fine. And that cash piece around the refurb, that is more just about, that's more a cash flow thing than it is actually
cash flow.
Yeah. So
Absolutely.
They want
you will get that. Yeah,
you get it
they
back.
want you to start that. Yeah, but you will get that back.
Yeah.
Obviously you've got to have the cash to start with.
Yeah. Okay.
And you can use private investor money in the mix with both of these options.
Okay, so this was a question I was going to ask you. Yeah, are they open to it? Of how transparent do you need to be with this stuff?
Yeah, you absolutely need to be transparent, because at the moment everyone's asking for literally, everything inside
leg measurements. Yeah.
Everything needs to be documented. So we need to see bank statements, we need to see build up of funds, we need to see exactly where the money is coming from for the deposit and the refurbishment costs. But private investor money is fine. It needs to be part of a bigger picture. So if this is your first project and you're pushing yourself on your experience and you're borrowing all of the deposit and all the refurbishment money, it's probably going to be a no. If you've got plenty of experience in the background, fine. If you've got money there, so say you have 50, 60,000 that you could put towards it, but you don't want to, that's fine. And that's quite a nice way of dealing with it, because you have got the funds. If it all goes wrong, you've got the funds there. And then I suppose we can play it like you're putting your money in and you're replacing your funds with investor funds, if you like. So we can position it so that you have got funds that you could put in, you are putting in if you want to. So it's got to be a bit of a balance there. But we have done plenty of deals where clients have not put any of their money in themselves.
Okay.
But they've got the experience and the background. They've got a decent portfolio sitting there. So they're a good client overall that a lender's going to want to lend to. They've got proven experience that they've done these things before.
Okay.
They've got the portfolio to back that up.
I think this is a really interesting conversation, because I'm pretty sure that there'll be a lot of people listening today who just had their eyes opened by this conversation, because actually there's so much more flexibility with bridging products now, specifically for HMOs, than I think a lot of people are aware of. But at the same time, there's also so many different ways to do it. And I think that that's really, really important to know. And a little bit worrying to know that you could very easily go to the wrong person and end up with the wrong product and end up coming out of the deal in completely the wrong way.
Oh, completely. And I've had so many examples of that recently. A few HMO roadmap clients actually that have used different brokers to start with and have come to me on the refinance. And they have been in really sticky situations. I think you've just got to be so careful. I just think that you need to do your research around things. I think some people are so quick, and it's not just mortgage brokers, around solicitors. I've had some really bad examples of solicitors recently where clients have literally gone to 3 companies, got 3 quotes, gone with the cheapest, and that's it. And you just think it's more complicated. Once you start getting into it's not just when you buy your house, you don't even need a solicitor. You can use a conveyancer. It's a couple of £100, isn't it, rather than a few thousand. Personally, I would never do that. I think solicitors are worth the money, and I'd absolutely pay that, even on a house. There's more to it. When you buy things, there is value to what you are buying, or there should be value to what you're buying. You don't go into John Lewis to buy a fridge and literally only look at the cheapest fridge that you're trying to buy, do you? That's not the only consideration. So I don't know why sometimes it feels like, and again, it's not just mortgage brokers, there are plenty of people I can put into that category, that people only look at it on a cost basis. So you need to be looking at value. What are people adding? And I feel like if you come to somebody like me, it doesn't have to be me, but somebody like me, I will add value to what you're doing, because I will help you look at your GDV. So if I don't think the whole thing works, I'll say no. So you're not spending thousands of pounds on valuations for something that's just not going to work. I will make sure that the mortgage goes through probably a month quicker than a lot of other mortgage brokers, because we chase it all the way through legals to try and get that completed. I don't just get it to offer and leave it. So if you're spending a month less on your bridge, there's a cost to that, isn't there? So it's all those things that have got to balance out, isn't it? But you've got to do so much research around these things.
I mean, I think it's worth reiterating, you are a specialist in HMOs. Like, you really do specialise in HMOs and lenders who work with HMOs, and that is so important, especially when we look at all these complications. Your average broker who might have access to some of the same lenders and things like that won't necessarily know which lenders are going to be the most suitable. You made the example of the legal team, who you choose to do the IMS, the monitoring surveyor. You can often choose things like that. The valuer that you use. These are all things that you have experienced. And I see comments and questions coming from the community regularly about, can anyone recommend on commercial valuers in a particular area? Which again, it is different depending on where you are in the country, you know, how things are valued up. And you've got that experience of those sorts of projects, and because you do them for so many people in different parts of the country as well. So, I mean, look, for me, you are an absolute no-brainer. I don't understand why anybody would go anywhere else.
I don't know either, Andrew. I just don't know.
No. Look, I obviously might be a little bit biased there, but I know how many people in our community you help, including myself. And, you get this stuff wrong, and it can take an awful long time, and it can be very, very expensive. And it doesn't have to be like that. I think that's the bottom line for me.
I mean, I could sit here for hours and tell you experiences about clients that have gone, and done things that just haven't worked. I mean, we had one recently where a client is trying to buy this property, and they'd gone to a broker who'd gone to a lender who had randomly had an inquiry from another person trying to buy the same property. They'd already had a valuation carried out on this property, and the GDV had come in at 350. He somehow managed to get hold of this report, and I read it, and the valuer just didn't get it. They didn't get the property. They didn't get the location. They just didn't understand. And he looked at it, and I was like, I feel like if we went to a better valuer, we wouldn't get this figure. And he was really unsure, didn't want to spend the money on the valuation, but obviously did want to buy the property, and he did believe in the project, but was just really unsure about it. So anyway, I went through all the figures. It's somewhere actually quite local to me, so I know the area. And I really thought that we could achieve a GDV of 500,000. Anyway, long story short, we've gone to a different lender. We've chosen the valuer, and he's got a GDV of 520. So, it's like, it does work as long as you've got the right things. I mean, it's worked out in my favour that this other deal didn't go through, but it's all about that valuer. They're a London valuer. I wouldn't have picked them. They don't know the area. And it's all about that, isn't it? But it's just so many little tiny components to the whole thing. If you don't know what you don't know, as an investor, you don't know all the little things that I've got to piece together to make a deal work. And sometimes it just comes across like I'm just doing it, but there's all those little things that are going on in the background.
Well, somehow we've managed to string a conversation about bridging out for 40 minutes, and I feel like we could continue, but I'm not sure what that says about you and I. Ellie, another fascinating conversation, as always. Really so useful to just have a look behind the curtain and understand what is going on with lenders. I think this is going to be a really valuable episode for so many people. For anybody listening who is looking at buying something, has had an offer accepted, or just wants to speak to Ellie, head to the hmoroadmap.co.uk. We've got a page under the services tab. Hit that, scroll down, you'll find a page specifically for Ellie and her finance services. Go and drop Ellie an inquiry. As long as she's not on holiday, she'll get straight back to you. She's helping so many people in our community, I can't tell you, but it's all there. So, Ellie, thank you so much for coming and sharing all this information again.
Thank you for having me back, as always.
Yeah, I think this is going to be a really useful one. And, well, I think your inbox is going to pile up in the next few days.
I hope so, but I genuinely, if somebody's got a project they want to have a look at and you just want to talk through the figures and see how the GDP works and all that sort of thing, I'm more than happy to have that conversation. So yeah, as Andy said, short me a message.
How many brokers are going to say that to you? Not many, if any at all. Wonderful. Well, thank you so much, Ellie, and I'm very much looking forward to having you back on the show next time.
Yeah, absolutely. Thank you.